If all of your money, or the majority, is in a pre-tax account like a 401k or IRA, this is the specific video for you. I talk about a lot of different topics on my channel. You're never going to hear me talk about what's the best new credit card or travel hacking. That's not my thing. My thing is early retirement planning. How can you keep the most of what you've worked so hard for? And for most of you, you've invested really well. Your 401k, your IRA, it's now about how do we minimize tax liability to once again keep the most of what you've earned. So what I'm going to be going through in today's video is showing you here's how to think about moving money when it makes sense and when it doesn't make sense from a 401k or IRA to a Roth IRA, also known as tax arbitrage, to save you the most in taxes, not in a single year, but over the course of your lifetime. And that is what we help clients do here at Root. I'm going to show you how we do it. I'm going to walk you through an example right now. The reason we're going to use this example, this is a real couple here. Luke and Shane, 55 and 47, protecting their last names for security purposes, no children here. Now, they want to retire. They want to make sure they're looking at everything in the right way. They want to optimize their financial situation. They have $1.9 million. That's all in a traditional 401k. Now, that's not uncommon. I'll see a lot of people who come to me, and if I click add account, investment account, this, by the way, this software you can all get access to in the description of this video here if you just look below. But you can see there's a lot of different accounts out there. There's taxable accounts, there's 401ks, there's Roth, traditional IRA, inherited accounts, SEP IRAs, HSAs, college stuff, pensions. Don't worry about all this stuff. The majority of you who come generally have a mix of some of this. Maybe there's an old 401k, maybe there's an inherited account, maybe you have a Roth, but this is not the case here. In this case, I'm just going to move myself for a second here. This is all they've got. It's 1.9 million. Now, when I say all they've got, they've done a really good job. So I'm not saying that in a condescending way in the slightest. I'm just saying all they've got, meaning it's all in one account. So they've done a good job. They're trying to think about, can they retire? Is it the right time? Now, the reason a retirement's even remotely possible for them is because there's something that's called the rule of 55. And what that means, I'll do it with you just so you can see. If you search rule of 55, oops, not rule of 55, this is a real rule from the IRS that allows you to take penalty-free withdrawals from a 401k or 403b before 59 and a half. So the reason that that's valuable is here's someone that might want to leave work and they've saved and invested well. They used to think I have to wait till I'm 59 and a half, but that's not the case. Now let's pretend all the money was in Shane's account and Shane's 47. Then they would have to pay significant taxes and penalties. So just an example here, this 1.9 million, they want to make sure they're optimizing. So the first thing we would look at is, okay, one, are they on track? But we want to make sure they minimize taxes. So we're going to get to the tax component in a second. This is the coolest part of this software, in my opinion, because you can actually run tax returns for years that don't even exist yet. Into the future, you can project tax liability. What we're going to get into in just a little bit is what is the value of good tax planning, where it can be significant, where you can literally save hundreds of thousands, if not millions of dollars, if you're doing what are called Roth conversions in a really intentional way. But before we get to that, which we certainly are going to get to, the reason, once again, I do these videos, the biggest video I've ever recorded got over 400,000 views from you guys. And this was on this topic of, hey, I'm 60, all my money's in a pre-tax 401k. How do I minimize my taxes? Roth conversions. All my videos, I'm trying to give various concepts, but it's primarily, once again, health insurance, withdrawal strategies, all my money's pre-tax. What do I do? So once again, this is that same example. What we're going to do is see what is this couple on track for. So as of now, if they retired at 58 and 50, so they both work 3 more years. They have some basic long-term care costs that we're assuming in here, and pretend we had a long conversation. Okay, weddings, new cars, home remodel. Ideally, they would put some more figures in here. But to keep it really simple, just for a second here, we're looking at the plan. Are they on track? The first thing that we look at, it shows a graph that shows they're on track. So here they are, 54. If they work from 54 until 58, and 47 until 50, they're on track for about 2 million at the end. Now, for some of you, you might go, that's not enough to leave to my children. Others of you, I'd say most of you, go, no, I've saved and invested well. I want to make sure I am enjoying the fruits of my efforts. Okay, great. Like this couple, that they had planned on spending $6,000 a month in retirement. What if they said 7,000 a month? Excuse me. If they spend 7,000 a month, yeah, there's 800,000 fewer dollars, but there's still 1.3 million at the end. However, once again, all their money is pre-tax. So the reason this is so important is we want to understand their tax liability. And the tax liability, this is oftentimes someone's biggest expense. So if we click on the cash flow tab here in a summary here, and I'm doing that so you guys can see how it works. Here's how you're going to look at your retirement. I would encourage you to do this if this was your income. So pretend this is you for a second. You're 55 and you want to retire in 3 years. So in 4 years, zero income. Well, they bring in 194,000 today, then 199, then 205, then zero. Now, when they have zero, they're going to need income to live. It's just they don't have salary anymore. So their expenses are in this column here, 120,000 expenses. Goals, that's extra vacation. So they're up against, 130,000, but they also have this big tax bill. You see this 46,000? That's because they're going to have to pay taxes to be able to take out money to live. So yeah, they only need 130,000, 120 plus 10. But this 178, that includes this 46,000 of taxes. So they really need this far number here, 178. That's really how much money they need to live so that they can pay for all their expenses, living, housing, healthcare, and do what it is that they want to do in retirement. So this number on the far right, that's really what we're up against. And what you can see here is as we go into the future, some of these expenses and taxes, they actually shift. So for example, starting in 2037, they might have Social Security that gets turned on. So now $52,000 a year is coming in. That puts less pressure on the portfolio. So that means if 52 is coming in the door and 146 needs to go out, you can see here, we can actually take this amount here, 181, which is the total amount needed, expenses plus goals plus taxes, subtract what's coming in, Social Security, which means 129 is what needs to be created. So the reason we bring this up is I'll see too many people make the following mistake, where they'll go straight to this tax strategy button and they'll go, I got to do these Roth conversions. It looks like it's going to make me so much more money. Yes and no. The reason I say yes and no is if you mess around with some of these toggles here, it's going to show that it's going to make way less money. It could still be valuable, but it also is going to look very different. And you need to understand, okay, how do I use this tool? So the number one thing is this is not a complete video of a exact lesson on how to use this tool. That is available inside of my Early Retirement Academy. So if you want to actually see and get access to run your own what if scenarios, you can go do everything I'm doing right now. I would just encourage you to make sure you watch the lessons on it. So in my section of how do you minimize taxes, I'm going into more detail on that. For here, if we're in this wondering, how do we minimize our tax bill? We have to ask ourselves, what's the point in life? And I know that sounds really cliche, but give me a second here. Is the point in life to minimize taxes, or is the point in life to get the most life out of your money? Because I'll see people that go, I'm not going to travel. No way, no way. It's going to cost too much and I've got health care. Oh yeah, I don't have Social Security yet. I'm not going to travel. Then they're 80 and their health isn't where they want it to be. They have plenty of money and they wish they spent more in the earlier years of their careers where they had health and energy, and earlier years of their retirement, should I say. So don't make that mistake. So what I would encourage this couple to do is really get detailed on how much do you guys want to spend? Okay. Are there weddings or new cars you want to plan for, help kids? Are you going to do a home remodel? They don't have children, but maybe it's nieces or nephews. So once this is all built out, pretend that they've built this out fully and they're really comfortable with this. If they were to pass with 1.3 million, is that enough? Let's look at their withdrawal rate, meaning how much they would take. Is it sustainable? It's actually higher than I would like. 6%, 7%, 6%, 6%. Guys, here's what's confusing about retirement planning. You can go to this button here. Software is just software, okay? It doesn't know you. The software here is saying, hey, you might have $380,000 more dollars if you do exactly what you put in here with these Roth conversions. But guys, why would you do Roth conversions? Why would anyone do this? The reason someone, make sure you understand, the reason someone does a Roth conversion, there's two reasons. Number one, if you're going to be in a higher tax bracket in the future, or you're projected to have more than you'll even need, and you want to make sure you're optimizing your tax situation. So this couple here, guys, they don't need to worry nearly as much about Roth conversions. What they need to worry about is this high withdrawal rate. If they retire early, they're going to take out 6-7% of their portfolio. If they have to convert money from their 401k to a Roth IRA, they're going to have to pay taxes. That's going to only increase how much they have to take. Now, here's the good news, guys. Here's the good news. And this is why the software is recommending Roth conversions. In their 60s, maybe they're traveling less, they're going to have a really low withdrawal rate. Then all of a sudden it jumps up at 75. This little jump right here, that's saying that they're going to be forced to take out more than they'll even need. So watch this for a second. Pretend I said, guys, they want to spend, let's say, $9,000 a month in retirement. So not $6,000 a month, but $9,000 a month, okay? The withdrawal rate is going to be really high, not sustainable, 8, 9, 10%. You can't take out that amount every year. But the tax strategy you're going to see here, it's now going to show it doesn't add more money. So this is important. Why am I showing you guys this? Because at the beginning of the video, you could see it said, it's going to add millions of dollars. Before you start playing around with fancy tax strategies, make sure you understand how much you want to spend. Make sure you're not just getting by. That's my pet peeve. I think I could get by in retirement, living off of eggs and top ramen. Don't do that. How much would you love to spend? Be honest with yourself. If you want to spend $10,000 a month, great. Make sure that's factored into the plan. Make sure you're being very strategic with where you're pulling from. Make sure you're being honest with your legacy goals. Only after you do all your planning analysis, if there's still more left over than you'll need in the future, and you'll still be in a higher tax bracket in the future, maybe we should consider a Roth conversion. But don't be what's called conversion happy, where you're just so angsty to do a Roth conversion to minimize taxes that you forget everything else. If there was one video that I would encourage you to listen to, search this, stop. I'll put it in the description below, but stop why you shouldn't do a Roth conversion. Now, if you listen to this video and you still want to do a Roth conversion, beautiful. I don't know what this ad is. Let's see, maybe we're going to learn about lemons today. No, I'm just messing around with you guys. But you can see here, if we skip this ad, this is myself and my partner James, and we talk about Roth conversions and how they're like surgery. And we go through all these in-depth examples for 30 minutes about why these don't always make the most sense, and a lot of people resonate with that. So that is what I wanted to show you guys. I hope that this episode was helpful. Once again, if you want access to this Early Retirement Academy to go run your own scenarios, run your own planning, by the way, you can go and do long-term care and insurance and estate planning and all this fun stuff. So if you want to work with Root, you can, of course, go to our website. You can actually, what I'd encourage you to do is go review our advisors. Go meet some of our team members. Why did we hire Chris? Why did we hire Katie? Why Harry? Why Steven? Why JJ? Go learn about them. Watch their video. See who interests you. Really start to look into who you think you might enjoy working with. The main reason people work with Root is so that they don't spend their retirement having to have a new job in retirement. You're paying to free up your time. So if you're wondering more about just, hey, how is it we actually work at Root? Like, what do we do? What's the framework? What's the process? You can go to the FAQ sections here and you'll learn all about us and more. And that's it. Thanks, guys. See you next time.